All right, so now we've identified our contract and the performance obligations. So now we're moving on to determining what the transaction price is. So your transaction price is going to it's going to be essentially the consideration you expect to be entitled to for transferring goods or services to the customer. So you may remember from earlier I talked about this notion of what you expect to be entitled to for transaction price. So it's not necessarily what you expect to collect. So remember, we evaluated collection, whether collectability is probable in step 1. If you pass that step, then you're not looking at collectability again from a revenue standpoint when you're determining transaction price. Your transaction price, if you have a situation where the amount you expect, you have a transaction price, just make it simple, of $100, you expect to collect 98, so you pass step 1 because you expect to collect substantially all of it. Your transaction price of 100, that's what you'd end up recognizing as revenue. And the difference between those two, the $2 in my example, if you expect to collect 98, that would be a bad debt expense. So from that's where the difference is in the entitled notion versus what you expect to collect. The only time you're considering collection risk in transaction prices if you have a significant financing component, which we'll talk about shortly when that considers collection risk. Now, unlike when we talked about earlier, step 1, once you identify you meet the contract existence criteria, kind of move on to step 2 and only reassess if there's a significant change in circumstances. For transaction price, you continually reassess your transaction price. So you have to keep updating your transaction price as you perform under a contract based on any changes that might have occurred. So that's different from your step 1, and it's also a little bit different from we'll talk about step 4 on determining your standalone selling price. So what goes into transaction price? What could be the components? We've listed out 5 potential components here on the slide. So the first one would be, fixed consideration. So fixed cash consideration. So the amount you're going to receive or your per the contract if you perform as required. This could include upfront non-refundable fees. Today on upfront, when we're talking about accounting for upfront non-refundable fees, there's actually guidance out there that says, if you have an upfront non-refundable fee and you haven't performed, you'd recognize that over the longer of the contract term or the expected customer life. Well, that type of guidance is not included in the new standard. If you have an upfront non-refundable fee, it's just part of your transaction price. You recognize it as you transfer all your goods and services. So that may just result in a situation where you're recognizing that fee earlier than you would under today's guidance. Now, there are cases where you have to recognize transaction price over a longer period than the contract term if you have a material right, as Rich talked about earlier. So if those options are material rights, you would have to recognize it over a longer period, but it is different guidance from today. We're going to talk in future slides about 3 of these components: variable consideration, significant financing component, as well as non-cash consideration. But wanted to briefly touch on consideration payable to the customer here. So obviously when you have an arrangement with your customer, typically that customer is paying you. There are cases where you are making payments to your customer. And the question there is, what do I do with those payments? Are they a reduction of the transaction price, which ultimately results in a reduction of revenue, or should they be recorded just as an expense like any other payments I make? And what the guidance says, and it's pretty similar to today's guidance, is that you're going to record that as a reduction of transaction price and revenue unless you're receiving a distinct good or service back from your customer for the payment, and that distinct good or service has a fair value equal to or greater than the amount you're paying that customer. So if you have a situation where Coca-Cola happens to be your customer, and completely unrelated to that, you're making payments to Coca-Cola to buy soda. In that case, you would say, no, that the fact I'm buying from Coca-Cola soda has nothing to do with the fact that they're my customer, and I am getting a distinct good from them. So I just record that as a normal expense. That would be an example where you're recorded as an expense, whereas other situations, you're just giving rebates or refunds to your customer, consideration payable to a customer. That will be a reduction of the transaction price and then ultimately revenue. Another accounting policy election that came up after the guidance ASU 2014-09 was initially issued relates to sales taxes. And there's guidance we'll talk about later on the notion of principal versus agent, or gross versus net revenue recognition. And that guidance relates to when you have situations that involve third parties and you're receiving funds from them along with your, or making payments to them and getting payments from your customer, whether you recognize all amounts received from a customer as revenue and any payments to the third party that's working with you as cost, or just net the two of them out and recognize the net as revenue. And so the question came up regarding sales taxes that you collect from customers, and whether those sales taxes should be recorded as part of revenue as well as cost, or just netted out and not recorded as part of revenue and cost. And the initial guidance would have said that you have to evaluate every single sales taxing jurisdiction to determine whether you are a principal or an agent, to determine whether revenue should be recognized on a gross basis or netted down. And questions came up as to, well, there are thousands of different sales taxing jurisdictions. Does that mean as a company I have to evaluate every single one of those? And they said, well, here's an election you can take. You could basically just say, well, if I make this election, I'm going to record sales tax on a net basis. So exclude it from transaction price and exclude it from revenue and costs. If you don't want to make that election, then you can go ahead and evaluate all those sales taxing jurisdictions you have to determine whether you're a principal or an agent for those sales tax. But my guess is most companies will be making this particular policy election. Okay, variable consideration. We've touched on this. I've mentioned this a few times earlier, but there are a number of situations or scenarios where consideration would be considered variable. I mentioned bonus penalties earlier. So bonuses, you could potentially get additional amounts. Penalties, you may have to pay some amounts. Discounts, returns, also, or rebates, also items that are where you're potentially paying money back to your customer. I mentioned price concessions earlier. So this one is going to be one that's going to be difficult to evaluate whether something is a price concession, so it reduces transaction price and hence revenue, or is it bad debt expense. So situations where you can get different amounts are variable, potentially different amounts are variable consideration. Also, there may be situations where you know the amount, but it's unclear whether you'll receive it or not. So let's say you're an attorney and you're doing a case and you're only going to get paid if your client wins. In that case, let's say the amount you get paid is $1 million if they win. Well, the amount itself is fixed at $1 million. However, you don't know if you're going to collect it because it depends on what the outcome of the case is. So that would still be variable consideration now. And this could be, it's simpler when this is explicit variable consideration. So it explicitly says you'll get a bonus if you perform, deliver something by X date. But it could also be implicit. Think about the price concession example. When you have price concessions, those generally aren't going to be explicitly in the contract. They're going to be implicit type items. So you have to evaluate all of these items, not just look at the contract itself. So when you have variable consideration, what the model is that you are going to estimate the amount of consideration you expect to be entitled to. Compare this to today, where outside of certain industry-specific guidance, when you have, say, bonuses, you're generally not recognizing that revenue until you meet that criteria. Under ASC 606, you're going to estimate those amounts. So you may be recognizing them earlier. And so your estimate is based on the amount you expect to, a model that's most predictive of the amount you expect to be entitled to. And there's two models or methods, I should say, that are laid out in the new standard: the expected value method and the most likely amount method. So what an expected value method would be is you would say, well, I'm going to look at all the different probabilities and the potential outcomes associated with those probabilities and determine what that expected value is. Essentially do the math. What's the percentage likelihood? What's the amount I would receive if that occurs? And kind of average them or add them all up. So that's usually going to be done when you have situations where there are lots of different potential outcomes of the variable consideration. Most likely amount method is, as it sounds, you would look at your potential outcomes and say, well, I'm going to estimate based on which one is most likely. Which one is more likely to occur than the others? And this is typically going to be used when there are situations where there are fewer outcomes. So you're either going to get a bonus of $50 or $100. So there's only a couple of outcomes, so I would generally use a most likely amount method rather than an expected value method in that case. Now, so that's a little, I would say, not aggressive, but not conservative like today's model. But then if you take a step, your next step is you don't stop there. Now you have to say, okay, I came up with my estimate. Now I have to say, if I included that amount in transaction price, I can only keep it there if it's probable that there won't be a significant reversal of revenue. This is the variable consideration constraint. So essentially what you're doing, you estimate the amount, and then you say, okay, if I include it in the transaction price, is it probable that that won't reverse, so that there won't be a significant reversal in cumulative revenue? So it almost becomes a higher bar to actually include that estimate in transaction price. So that is something that is you have to perform both of these parts of the estimate, and it can be done together at one time, but it really is a higher bar. You come up with an estimate, you have to make sure that it is probable that it won't reverse. So that can be something that, while initially you might say, oh, okay, this is a lot less conservative than today, it gets knocked down a bit because you have this constraint, and you can't include the amount unless it's probable that it won't reverse. Now, when you're making that evaluation as to whether it's probable it won't reverse, there are a number of factors they included in the guidance or indicators to help you to make those considerations. So they said if you have these indicators, then it's less likely that it's probable that the amount won't reverse. So it's more likely it will reverse. So things like, well, are the outcomes out of my control? Are they based on third-party regulators or something out of my control? Are there lots of different outcomes? So the more outcomes there are, the less likely you could say it's probable it won't reverse. Is the outcome going to be determined over a long period? So do I get a bonus, but it's based on results over 4 years? Longer period, less likely I could say it's probable that it won't reverse. If I often offer concessions in these situations, again, that would make it more likely that it will reverse, so you can't include it in transaction price. So definitely something that needs to be focused on. If you just stopped at the estimate and they didn't have this second step, this constraint, you wouldn't have these kind of extra complications, but that is part of the model, is variable consideration constraint. Also, there's another specific exception, and this is on sales and usage-based royalties. And so what this guidance on this exception is, and this is purely an exception, it says, well, if you have a situation where you have a sales or usage-based royalty and it relates to the license of intellectual property. So think about a scenario where, you're licensing some software to a customer and they're going to sell it to a third party and you're only getting paid depending on how many sales they make to the third party. You're getting a percent. Well, that's a sales-based royalty. Or you might have you're a movie studio and you're allowing a broadcasting company to play your movie, and it's going to be they pay you a certain amount based on how many times that movie is shown on their television station. It'll be a usage-based type royalty of intellectual property. So in those situations, there was concern that companies would be making estimates over long periods of time on these sales and usage-based royalties and including them in the initial transaction price and recognizing a lot of revenue early that might later be reversed. So they put in this specific exception which says you essentially do not estimate those sales and usage-based royalties included in transaction price. So don't make an estimate. You cannot include it until those sales or that usage actually occurs. That's the point you include it in transaction price, and you can recognize it as revenue. Now, questions came up as to, well, what if you have situations where you have some royalties, but it's not just for a license? There are some goods and services involved. So let's say it's a franchising situation and you're licensing your franchise name, but they're also selling some equipment. So in that case, the question was, well, what do I do with the sales and usage-based royalty exception? Do I apply it there or not? And they included some additional guidance that said, well, you're evaluating what the predominant item that is related to the royalty is. If it's intellectual property, apply this exception. If it's not, don't apply this exception. You wouldn't go ahead and kind of split up the sales and usage-based royalties and say for some you apply the constraint and for others you don't. So I think it makes it a lot easier from an estimate standpoint because you don't estimate in these situations. You just wait until that sales or usage occurs and you've performed, and at that point you recognize include the actual amount in transaction price, and ultimately at that point you'd recognize it as revenue. Okay, rights of return. There's some nuances to rights of refund or return compared to today, but a right of refund or return is considered variable consideration. It's not a separate performance obligation, so it's not something where you have to say, well, I have a performance obligation to stand ready and accept this returned item. That's not what it is. It is variable consideration. So you have to go ahead and estimate those refunds. Typically what you'll be doing, you'll have lots of product sales out there and you're going to estimate it generally using an expected value method because each particular sale only has one outcome. It's either going to come back or not. You're probably going to be looking at it more on an aggregate basis to estimate what percentage of our products are coming back. So that would lend itself more to the expected value method. If it is just a like-kind type exchange that's similar to today, that's not accounted for as a return or refund. And if it's a defect issue, similar to today, that's under warranty, so that's not a right of return or refund. So what do you do here? Well, you got to estimate those returns or refunds. Whatever that estimate is, that's a reduction in transaction price, which ultimately is a reduction in revenue, and you record a refund liability. Now, one difference from today is if you have a situation where you can't reasonably estimate returns, you have to defer all the revenue. Under the new guidance, that's not included. So you have to come up with an estimate. Even if you don't have a history, you have to come up with an estimate of returns. So it's going to result, if you have that situation, will result in earlier recognition compared to today. Now, if you have returns and it relates to product sales, what you're going to do is you have to derecognize the entire product, so the entire piece of inventory, and you would separately recognize a right to an asset for the returned inventory. So that would be recorded. It's not inventory anymore. It's just a right to get that inventory back based on your estimate. And the amount that will be recorded is the cost of the inventory expected to be returned, less what it would cost to recover that particular product. So not necessarily just book value that you have the particular inventory recorded at. It might have to be less than that amount. And your offset to that will be to cost of sale. So today, I think in many cases, companies, rather than recording this right to returned inventory, they might take that asset and net it down with the refund liability, just record it net. Whereas under the new guidance, you do have to record this separate asset for a right to return inventory and include your estimate for refunds on a gross basis. Okay, moving on to significant financing components. So a significant financing component would be a situation where you're getting paid significantly in advance or significantly deferred in a transaction. So you're getting paid in advance of when you perform, or you're getting paid later than when you perform. And so what would happen in these cases, if you have a situation where you're getting paid significantly in advance, essentially the way that's looked at under the new guidance is that the customer is giving you a loan. So when you get a loan from someone, you're going to record interest expense. So you're going to have interest expense over time in that situation, and there's got to be an offset to that. And the offset to that is transaction price or increasing transaction price and ultimately revenue. So you might have a situation where you get paid $100 in advance, and because of applying the significant financing component guidance, you'll ultimately recognize some interest expense, let's say $5, which is offset by $5 of increased revenue. So you receive $100, and out of that you might recognize $5 in interest expense, offset by $105 in revenue. So that would be a gross up, and that's something that's very different from today. You wouldn't see that today. As far as deferred payments, if you have deferred payments, then you're getting paid way later than when you perform. That means that, as essentially looked at, is you're giving the customer a loan. And when you give someone a loan, you record interest income. So you would record interest income over time, which would result in a reduction in the transaction price and a reduction in revenue. So if we take my $100 example earlier and say that that's a deferred payment, Well, ultimately, you might record $5 of interest income and only $95 of revenue. You might see that in some situations today, and also a difference from today might be that if you have significantly deferred payment terms, today you might not be able to say the consideration is fixed or determinable, which would mean you couldn't recognize any revenue until you get paid, so that could potentially be a difference. So what are you looking at here when you're evaluating whether you have a significant financing component? Where you're looking at, well, what would the customer, if the customer paid today, what would that amount be compared to what they're actually paying? What's the difference between those amounts? Also, you're looking at the timing of the difference between the timing of when the goods and services are transferred, when you get paid. Also looking at your interest rates as well. If you have a significant financing component, when you're looking at the interest rate you'd have to include, it's not necessarily the implicit interest rate in the arrangement. It will be a rate between you and the customer that would be entered into on an arm's length basis. So if you didn't have the particular you didn't sell the good or service to the customer. So that's where you might have to consider the customer's credit risk in a significant financing component. Now, one of the good things here is there are a number of exceptions to this guidance, so it's not like in every transaction you're going to have a significant financing component. So a few exceptions that are listed here. So if it's a situation where there's an advance payment from the customer, but you really don't know when you're going to transfer the good or service, so it's based on when the customer wants it, that's excluded and is not considered a significant financing component. So the typical example here is gift cards. Customer buys a gift card from an entity, and they can redeem it over the next couple of years. So it's out of your control as a vendor, so no significant financing component. That's an exception. Also, another one which I've seen a few times, or gotten questions on a few times, situations where if there's variable consideration and it's out of your control whether you're going to get paid that amount. So you might have performed today. Let's say you're doing some R&D for a company, and you're going part of the consideration is variable based on whether that's ultimately approved by the FDA. So that's out of your control, significant variable consideration. You would say, I would apply this exception, no significant financing component there. The last one relates to, well, is it they're delayed or advanced payments, but it's really for other than financing. And this was really added to the guidance because I think initially to capture typical construction contracts where there's a holdback payment, so the customer won't pay the last 10% until they've approved everything at the end. And so what this guidance says is that, well, in a situation like that, that difference in timing of payment and performance is due not to financing, it's just due to making sure the product is acceptable. So you'd say that's a reason other than financing. That being said, that the guidance is not limited to those construction contract scenarios. So it does have to be evaluated by all companies, and many companies are not all that enthused about applying this significant financing component guidance. So we're seeing, at least through some of the AICPA groups, that companies are trying to have see if other situations should be included in this exception. Now, the final item is a practical expedient, so it can be applied if companies want to, and it essentially says, well, you can ignore your significant financing component if the timing of your delivery or you're providing goods or services and the expected payment is 1 year or less. So think about your typical payment terms where you have 30 or 60-day payment terms. That, if you apply this expedient, you wouldn't have to apply the significant financing component guidance. So I'd expect a lot of companies will be going down that path of applying this practical expedient because I think it is going to be difficult from a system standpoint for companies to apply the significant financing component guidance. So it will be something where they're probably going to be looking for situations where they can not apply this guidance if they don't need to. Okay, finally, the last item on transaction price is non-cash consideration. And the guidance says that if you have non-cash consideration, so you're getting paid in shares, let's say, you include it at fair value at inception of the contract, so included in transaction price at fair value. If you can't estimate that fair value, then you'd include it at the standalone selling price of whatever good or service you're transferring. It's a little different from today because today you would look to the fair value of the consideration or the fair value of the goods or services, so there might be a slight difference from today. Now the question comes up, well, what do I do if the fair value changes after contract inception? And the answer is it depends. If that change is due to what's called the form of the consideration, then it doesn't impact the transaction price or revenue. So change in the form of the consideration would be you issued some stock to a company, customer issued some stock to you, 100 shares. They're worth $100 on day one. As you performed, they jumped up to $110. Well, that change in price is considered a change in form, and that has no impact on the transaction price or ultimately revenue. However, if it's other than form, so let's say that same example, you got 100 shares initially to provide a service over time, then you met the customer gave you an additional 25 shares. Well, that's a change in other than the form of the consideration, so that would impact transaction price.